that's the tipping point. This market reminds me a lot of 1999. You're going to have a situation where that would, some form or another, would get the long rates down to try to get activity going at the long end.
What does happen if this so-called problem comes into fruition? What happens to the interest rate? What happens to inflation? What happens to asset prices? The FOMC cut interest rates by 25 basis points this week. Markets anticipated this. And what's remarkable to many observers is the fact that inflation is still running hotter. 2.9% headline CPI is the latest CPI reading from the last month, up from 2.7% the previous month. And so it's obvious now to many market participants that the Fed is now more focused on the labor market than on their inflation mandate. Joining us today to talk about markets, the labor market, and the economy is Ted Oakley, founder of Oxbow Advisors. Welcome back to the show, Ted. Always good to see you.
Good to see you, David. Thanks.
Let's start by talking about the labor market because, like I mentioned in the introduction, it probably is the Fed's focus right now, or at least it appears to be. Maybe they cut by political pressure, who knows? But I'll let you answer that. This morning, we got jobless claims. I'll just show you the report here. This is an article from Bloomberg. Initial applications for jobless benefits in the U.S. dropped by the most in nearly 4 years, reversing an unusually large jump in the prior week and consistent with low levels of layoffs in the economy. Initial claims decreased by 33,000 to 231,000 in the week ended September 13th, according to the Labor Department. That's in line with levels seen throughout this year and not far off the pre-pandemic trend. The median forecast in Bloomberg survey of economists called for 240,000 applications. So what do you make of the fact that we got these positive numbers, well, relatively positive numbers, which may signal the fact that companies are still holding on to workers despite previously anticipated weaker labor market environments?
Well, David, if you look at it, this thing about this, if jobs available are going down, job openings, and unemployment's going up, that just basically means you have more people vying for fewer jobs, effectively, what that means. And that's first time that crossover's happened in a long time, but that's where you are right now. And so I think employers probably would do that. I mean, every employer I talk to basically says, I'll keep my good people. And, if it gets tougher and tougher in here, we'll start at the bottom, the people that are least effective, and they're out of here. And that's generally what we're seeing. You have to remember now, too, one of the big employers, one of the big things going on in the country is housing, which is going nowhere, all right? And it's actually getting worse. So there's a lot of factors going into that, but it looks like it's certainly a negative to me. And the Fed just decided that's the way they want to go. I doubt if they're right. They usually are not right. And so we'll just have to see.
Housing has been going nowhere for quite some time. I've seen reports, heard from people that it's actually getting worse. So what you're saying is corroborated by other sources as well, Ted. I wonder why, though. Interest rates haven't moved and mortgage rates haven't really moved. We may have downward pressure on mortgage rates now. So why the weakness in the housing market?
Well, it's price. If you look at the last 4 years, David, it's price. It's not the interest rate, but if you look at it, if you keep a high price and they keep moving the prices up, they were spoiled for many years where builders could come in and just raise the price. Rates were really low, so it didn't make any difference, actually. But now you get into a normal interest rate. This is not an abnormal time if you go back over 60 years, 70 years. And now you got a high price. And, and you look at high prices, then you got insurance, then you got taxes on that high price. And if you look at a 30-year mortgage today, it's only about a quarter less than it was a year ago. Even today, I'm talking about today. So I think people get confused on this. You'd have to have rates come a lot lower to effectively move anything on interest rates because the price is out of line. They're too expensive.
Okay, so one of two things is going to happen. Well, one of a few things might be happening in the foreseeable future, that either prices will come down to adjust to equilibrium, whatever that equilibrium would have to be. Real wages would dramatically rise to keep up with rising home prices, or a lot of people are going to shift to the rental market, and that sector is going to boom. while the first-time homeowner market is going to slow? What do you think is most likely?
Well, I've got a graph of average hourly earnings just below the management level. And that graph always compares to the price of housing.
Yes.
And the last time it was really out of line was about '06, okay? But now it's twice that out of line. In other words, it's so far out of line that you would have to have some of both. You would have to have your wages go up and your prices come down to bring that business back into equilibrium, because you can only make, I've decided to make smaller houses, but I mean, you get down to 1,200 feet or so. I mean, that's about all you're going to get here. You can't, what are you going to do? Throw up a 600-foot house and sell it to get in just to say I have a house? Well, no, because I can go rent something much nicer. So that business is in a quandary, I think. Now, you'll always have the buyers that buy, the upper level, upper mid, upper level range where they have the money. So that doesn't necessarily fit, but just in general, I'm talking about that's what we see out there. But that has an impact. It has an impact on employment too. That industry touches a lot of people. So you just have to see how it works out.
Yeah, and if home prices do correct, that could have a real effect on consumer spending. It's been tied to, the price of your home, and therefore your net wealth has been tied to discretionary spending, even if your actual cash flow doesn't change according to studies. So we'll monitor that. Going back to the Fed and the labor market, one interesting question that was brought up to Jerome Powell at the Fed press conference by a reporter was whether or not the tariffs have been eaten, quote unquote, eaten by companies on the labor side, because apparently we haven't seen dramatic increases on inflation for all products across all sectors. That was according to this reporter. What do you think? Do you think company margins will start to reflect tariffs?
I think eventually, pretty soon they will. I've talked to a number of companies, private now, that basically buy, they're wholesalers, but they buy product to bring into the wholesale area. And what's been happening so far is those two have sort of split that a little bit, so that on the retail side they didn't get hit as hard. But they can only go so far with that. And after a while, they have to say, hey, you know what? Now we've got to pass some on. I think they're starting to pass it on, and you'll have to see how much they pass on, but it will get there. And again, I think that's going to show it in some of the numbers.
All right. I'd like to play for you a clip of Powell answering the question on why the decision was made. So this is his justification. Take a listen.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
Okay, Ted, I'd like to get you to respond to that, but my initial thought is this: Jerome Powell has been talking about cracking labor market signs for months. I mean, he didn't use those exact words, but he was cautious in the labor market ever since the spring, I remember. And back then, inflation was lower. And so unless the labor market, according to you and other analysts, is significantly worse now than earlier in this year, I'm wondering why they made the decision to cut rates now, given that inflation is much higher.
Well, I know they're not going to admit this, but you have to think that getting together like that, they get beaten on every day, from the White House to lower rates. And so they do it. But, again, the Federal Reserve the last 30 years has made it's just just nothing more than a whole 30 years of eras. And this is probably another era because, you look out 12, 15 months from now, which I think inflation will be back up again. And then they're really, then they're caught between a rock and a hard place. And there are certain things they can't control. But I think a lot of this was, they've been jawboned into doing it. My just personal opinion now. I don't have any. I have no contact or anything. But if you just watch what's happening, I think that's part of what happened. And so we'll do a little bit. But in order if you're really going into recession and you got a real true problem with unemployment, well, a quarter of a point's not going to do you any good. I mean, you need 150, 200 basis points. But again, then you come back to inflation, you see. So that's why you've got a group here that probably doesn't know what they're doing, but they never have. So there's not a lot of difference in that.
Gold is now above $3,600 an ounce, an unprecedented level. Now, you've heard me talk a lot about how gold and silver are smart ways to grow your savings over time. But what if I told you can now do more than just hold gold? What if you could also generate income from it? Well, that's exactly what today's sponsor, Monetary Metals, is doing. They're redefining how people invest in gold and silver. Instead of paying to store your metal or letting it sit idle, now you can get paid to own it. Right now on their marketplace, you can earn up to 4% yield on gold paid in gold. That means your savings grow in actual ounces, not dollars, on top of any price appreciation. Yield is deposited monthly in physical gold, which you can redeem and take delivery of. Thousands of investors are already generating a consistent yield in silver and gold, so it's about time you look into this as well. Go to monetary-metals/Lynn, link down below, or scan the QR code here to learn more. Well, you did mention in your notes, said to me offline, that moving from 4.5 to 4.25, basically a 25 basis point cut, isn't going to do much for borrowing. So what needs to happen to the Fed funds rate for more stimulus on the borrowing front? You mentioned 150 basis points.
Well, I think you'd have to go. You look at right now, prime is 7.25 instead of 7.5. And in order to get people to take a lot of money, you've got to get it where it's cheap enough to borrow. To me, it's at a point where they can't get there because you would have to have, you're going to have a prime that's 300 basis points lower than it is now, and you're going to have a situation where that would, some form or another, would get the long rates down to try to get activity going at the long end. That's another problem, though, because people see that inflation moniker out there and they're like, hey, you know what? I don't know what's going on. I know what's going on the short end, but on the long end, I'm not certain I'm willing to loan that money, like that. But if you go into a recession, they'll do the same things they've always done. They'll try to push it down. But right now, you would have to have a number that gets it down to where you could do business borrowing. I mean, to make businesses really jump out, and that's my opinion, having owned part of a bank and everything, you have to get it down to where they say, well, if I could do that at 4% or 4.25, maybe 4.5, I can make those numbers work, and so I'll go ahead and build that building or buy that piece of equipment. That may not be right. That's just personal opinion, but that's the way I would see it.
Right. On the topic of Fed independence, let me just show you this article. I want to get your reaction to this. This is from a Goldman report. Gold could rally to almost $5,000 an ounce if the Federal Reserve's independence were damaged. And investors shifted just a small portion of holdings from treasuries into bullion. A scenario where Fed independence is damaged would likely lead to higher inflation, lower stock and long-dated bond prices, and an erosion of the dollar's reserve currency status, analysts at Goldman said. In contrast, gold is a store of value that doesn't rely on institutional trust. That's a pretty big prediction from a big bank. But the underlying assumption is the erosion of Fed independence. Can you comment on that?
Well, if you look back in the 70s, where Arthur Burns was, he was succumbing to some of that pressure. So they would go up and down, but then every time inflation would be higher the next go round, a couple of years later, they'd have to go back in and, they had the win, with the win buttons, whip inflation down, all that. But when you get in a situation where you stack an independent board with people that are just going to do, for example, what the White House wants. And let me give you a real good example. Volcker, Reagan did not agree with Volcker keeping the rates high. That's what broke inflation. But Volcker bucked the system and said, no, we're not doing that. We're going to keep the rates high. And that worked in the long run. But if you've got a whole group of people now that just say, we're gonna do sort of what this particular party wants that's inside, regardless of the party, then I think you've got a real problem.
What does happen if this so-called problem comes into fruition? What happens to the interest rate? What happens to inflation? What happens to asset prices?
Well, your rates would come down a lot. They would keep on bringing them down. You would juice everything again. Asset prices would even become more extreme. But the flip side of that is inflation would take off. You wouldn't see it immediately the first month, but then you see inflation just like you did, a few years ago. Remember when we hit that 9% level, then you all of a sudden, here it comes, and inflation is a killer for middle income and lower incomes. I mean, that's the one that buries them. And then all of a sudden, then that throws the whole economy out of line. But then they'll learn a real hard lesson, But that's what happens if you allow that to go on.
Do we have the conditions today in place for inflation to return to 9.1%, the previous high a couple of years ago, post-pandemic?
Well, not sustainable, probably, year to year, maybe. But yeah, at points in time, sure, you could get there and you might back off. But I think generally inflation is going to be sustainable, though, between 3 and 4. That's why we don't own a lot of long-term bonds. They actually might work right in here right now for a little while. But we think it's a short-term phenomenon.
Yeah, you own short-term bonds, Ted? Not long-term?
Mostly less than 60 months.
Okay. I'm going to come back to the bond market in just a bit. Just finishing off in the economy. So Powell described the current jobs market as low firing and low hiring. He noted young people and minorities are struggling to find work. Generally speaking, Ted, what needs to happen to stimulate the jobs market? What needs to happen to incentivize businesses and employers to start expanding again such that they'll need to hire more people? Assuming, of course, people aren't quitting en masse because the labor market is just very strong.
Well, we have a legislature in D.C. that doesn't really understand all those things. But if they did the right thing, what they would do is something like an investment tax credit. So you would say, okay, to an employer, I'll tell you what, if you will hire this type of person at this level of income, in other words, one that's a decent level, okay, we're going to give you an investment tax credit for that. And then you're going to hire somebody. Hey, I need somebody, but now I can hire somebody and get a tax credit. You have to use tools like that to really get it going. And sometimes you can't get it going. I mean, you'll go through periods where no matter what you do, you're in a recession and you just have to keep on trying to work through it.
What about, so labor is the supply side. What about the demand side? Based on research from your firm or research that you've seen or even anecdotal evidence, do you have any comments on where consumer demand is sitting at right now? In other words, even if the government were to provide this incentive tax credit, like you suggested, would that matter if, let's say, customers are walking through the front door of the shop?
You're right. It might not. I'm not certain that would happen, because what's happening right now is that you got two pieces of the economy, and the bottom 65 or 70% now, they're just barely getting by. So this inflation thing, which is still out there, by the way, is really affecting them. And so from that employment standpoint, that's the fact. But if you don't have customers coming through the front door, you're right, then you got a problem. And I think to a degree, a lot of the consumer companies, honestly, I think they've been living off the stock market because people had a lot of value there, not value, but they've had a lot of liquidity in that. It's gone up. They feel good. They spend more of that money. That's probably one thing that would affect it as well. But consumers, I think in general, have been living off the stock market.
Well, let's just flip over to what you said earlier. You said it's about time companies start raising prices. This is an article that basically confirms what you said, Ted. Tariff fueled price hikes have arrived, hitting these items first. Among the companies to say they are raising prices for some goods as tariffs take effect are home improvement giant Home Depot, Macy's, and camera maker Nikon. This came in the 12th of September last week before the Fed meeting. So what does that mean for markets? What does that mean for investors when big box stores and retailers are finally starting to pass the tariffs on to consumers?
Well, that's the tipping point, because all of a sudden, I mean, we're a 70% consumer economy. So when you get in a situation where the things that you don't necessarily need, like a new Nikon camera, I'm probably not going to buy it. Or some of the things you don't really need is something you want, but you don't need it, but you want it. Those things go by the wayside. So you go back to things that you need. And so that's what changes in the economy at that point.
Okay. Are the wealthy people still feeling good about their wealth to the extent that they're able to absorb higher prices? In other words, let's take the Nikon camera, for example. The people that can afford an expensive Nikon camera, would they care in 2025, in October, September, that price has gone up, 20%? In other words, would it matter?
Well, I'm starting to see a little bit of that, even in people I know in our own.
Sure.
And they'll say, I have something, let's say, whatever it is, piece of equipment, whatever, and it's really good, still good. They've got a new model. It's supposedly a lot better, this, that, and the other. Well, when you're really feeling good about things and you think things are going to be great next year too, you don't mind stepping out and doing it. I'm seeing a little bit of that right now, but the markets haven't broken. So most of these people that have money are just they just spend it. That's all I can tell you.
Right.
They keep wanting. Now you have a 25% correction in the stock market, then you're going to see the consumer side break down.
Now that the Fed has begun easing, what is the primary theme for investors into the rest of the year? We've got higher inflation, potentially a weakening labor market, and an easing cycle. Interesting mix of monetary policy with economic growth.
Well, investors right now are feeling good because the markets just go up. This market reminds me a lot of 1999. It just goes up every day. Nobody knows why. There's a narrative. They always have some sort of narrative, but they just go up. So nobody really does anything. They don't do any selling, and maybe they do more buying. And the market just keeps right on going up, and nobody's worried about it. And in 1999, that's what 99 did all year long. And so you never sold anything, did everything about it. And I think now investors will try to chase the bonds, which is a mistake, by the way. Anytime you chase bonds, I think you're wasting your time. But what they should do right now, if they're worried about the rates, instead of keeping it short, like talking about in a money market or something, try to lock in a 1 year or 18 month, try to lock some of that money in. And if rates keep on going down, which looks like they might, then you've got some of that money locked up, but you're not out 30 years. You're just out a year or two, and that's the only way to, in our opinion, to make that work.
If you're not chasing bonds, what should you be chasing instead?
Well, I don't think you should chase anything now. If you look at our investing on the stock side, for example, we ride with what we have. We're still about the same, 40% in treasuries, 60% in stocks. We still own a lot of stocks, a lot of good companies, but we're not going to do this. The biggest mistake investors make, and we've all made this mistake, now I made it much younger, is that the market's been going up a long time. You think, okay, I want to pull the trigger, I want to get in, I want to buy more, I want to do, and you finally get to a point like Stan Druckenmiller did in 1999, where he said, I lost $3 billion in a short period of time. They asked him what he learned about it. He said, nothing, because I already knew not to do it. And I think people, they know not to try to speculate here, but they do it anyway. And this is a point where a good money manager will tell you, we're not going to buy that. I've already been down that road in my life. And you can't start to change everything you've ever known about value, what's worth this, what's worth that, and all of a sudden say, no, we're going to just jump on and try to ride this pony all the way. And I think that's where the mistakes get made in this kind of atmosphere.
You said this looks a lot like 1999. The implication is that it's right before an inflection in the market. March or April 2000, I believe, was the peak in the dot-com bubble. So, Ted, what can investors look at to understand inflection points? In other words, what do you look at in the economy or the markets to know that this is the beginning of the end of the bull market?
Well, for us, we look at the companies more than the market. Now,
Okay.
I will tell you, the market, I don't think they'll get anywhere close to hitting the numbers. They're looking at 16% of the estimates out there for increased earnings in 26. I don't think there's a chance they can make that. But what we look at are individual companies. And we see all kinds of companies. We don't own them. I'm just telling you, this is what you see. You see all kinds of companies that are selling at 40 and 50 times sales, not earnings. Sales, you see companies that keep on losing money, never made any money, their price goes up. There's so much of that out there right now, it's incredible. The leverage is out there. We're leveraged in every single area, private equity, private credit, all that. And those are the things that we look at to say, you can't play in that minefield because something's going to go wrong there one of these times. When it does, it'll blow up the whole thing. And I think that's what we look at. I could show you so many companies today that actually have zero value. If they handed you the whole company, you're not going to make any money. But people keep buying it and they keep throwing these narratives out. We like to buy companies that have real cash flow, real dividends. They're at a good value. They're at a cheaper price. That's how you make money in stocks in the long, long run. But at the top of these markets, you don't want to get caught buying into these things because you'll look up 2 or 3 years from now, just like I said, and say, why did I do that for? And it's just because you can't help it. The greed button is coming, and people start to say, I've got to get more exposed. Worst time.
Let's say you're somebody with a bunch of cash right now, and you're facing an environment where the Fed is lowering rates and potentially we have higher inflation. And at the same time, like you said, now is not a good time to be chasing prices and momentum. So what do you do?
Well, it depends on the age for one, but I will say that that's a big factor here on the age. But if you're younger and you have a lot of money, all of a sudden, you can put some of it in the market. I think you got to go low in the beginning, though. I'm talking about less than 20%. The balance, I think you have to keep, at least for the time being, in maturities that are 24 months or less, probably treasuries, maybe some high-grade munis. I do think there's areas you can own, which we own, that are cheap, may get cheaper in the short run, like energy, something like that. But go looking for companies that will pay you more than the 30. If you look at the 3-month treasury, it's just now gone under 4. So there's nothing in the treasury market that's less than 2 years now that'll pay you 4% anymore. That happened this week. So what happens is you have to decide, I want to own a little of some things that maybe would pay me 5 or 6 or 7, but they're in the dividend route, so I take a little bit more interest. So you get a balance. I think your balance right now ought to be towards safety, no matter how you balance it. If you're older and you have that liquidity event, you got to be careful.
What is safety for you, Ted, right now? Like you said, the bond market, if the long end of the curve keeps going up, well, that doesn't look great. Gold, is gold still considered safety at $3,700 an ounce?
Well, I think it is, David, because people misinterpret gold. I mean, gold is something you buy for when things go wrong, okay? Inflation, wars, countries all upside down, all sorts of things going on where there's fear. And but right now, it's also an item where if you look at the level of debt for our country and all these other countries, then they don't have any faith in those countries. And that's what, so I think if you're going to own bonds in here, and you can pick what you want to own, but I think if you're going to own bonds, you need to own 2-year or less treasuries, and you need to own a position in gold as a hedge. And people will say, well, what if it doesn't work? And it's an insurance policy on the long run, the rest of your life, because hey, if you have a home, you'll buy insurance every single year for that house. But you better hope your house doesn't burn down, okay? Because then it
Yeah.
pays off. But it's sort of the same way with gold. Just because you own it doesn't mean you're looking for some sort of extraordinary. But I still think it has, if you look at the setup for debt and the things that are going to go on this decade, I think you have to own some gold.
Okay. The Trump administration, not the Trump administration, the Trump family in particular has shifted a lot of the wealth from physical assets, real estate predominantly occupying their wealth traditionally or historically, now to digital assets. Trump Media is now, I believe, the 6th or 7th largest holder of Bitcoin in the world, depending on the day. Is this a trend that some of your associates or institutional clients have mirrored?
We have some people that have bought Bitcoin. Yeah, we have some. I don't. It's not something we recommended to them, but if they wanted to, they bought some of it. It's not a producing asset for us, and so it might wait the next 10 years. I'm not saying it's not. I'm just saying for us, it doesn't produce profits. It doesn't produce dividends. It doesn't produce, the only thing you get out of Bitcoin is an increase in price. And I always say this to people, but Bitcoin could go away. And there's numerous ways it could, all right? But gold doesn't go away.
Undervalued assets. You mentioned that energy looks cheap to you. Am I quoting you correctly?
Yeah, there's a number of single companies that look good too. Though we own
Right.
probably 45 plus companies, but a number of energy companies. But energies, energy was oil was 130 3 years ago. It's 63 now, 64. A lot of those companies have they worked their debt situations correctly, and they're paying anywhere from 4 to 6.5, 7% on the dividend, and the gas pipelines are paying 7 or 8. And so that group looks good. I don't mind owning things that'll pay me 5, 6, 7%, and I can wait a couple of years maybe, and oil is higher. And it could be significantly higher in the next 3 to 5 years, but let's just say it's higher, $100 a barrel, maybe 100, whatever. And see, I'm getting paid to wait. I'm getting a good dividend. I'm only paying 20% tax on it. It's not like interest from a bond. So it's an area we like for a lot of those different reasons.
Fair enough. Okay, so finally, the most overvalued versus the most undervalued assets right now, or sectors. So we talked about tech stocks a little bit. How would you allocate your portfolio right now, undervalued versus overvalued?
Well, we like to think that everything we own is undervalued, or we wouldn't own it. And we don't have, I mean, if you go back and look at a lot of the AI names, that have NVIDIA and all that group, all that stuff, we don't have that. We don't own that. We can't make the numbers work in those companies if you see the prices you paid, because they're fad stocks, and they're like a lot of the stocks were in 99, early 2000. If anything, you put the .com behind it, it just soared, but a lot of them went under. And I think a lot of this AI group is really overvalued in our opinion. I don't do, as soon as we see them and see they're really expensive, we don't do any work in that area, but that would be probably the most overvalued group I see.
This would probably be one of the strongest bull markets in recent history if you discount the pandemic. Final note, Ted, for young investors entering the space right now, what would you say to somebody who has maybe entered the space a couple years ago in an interesting environment, regime change, number one, Fed policy shift, number two, soaring AI-driven stocks, number three, and then pretty much all major asset classes, digital like Bitcoin, gold, and the S&P reaching new all-time highs, unprecedented levels in 2025. This person is probably thinking he's a genius if he's making a lot of money, which he probably is.
Well, we've all been there, okay? Yeah. And I promise you this, Anybody that's been around a long time has had their legs cut out from under them, and it it happens to everybody because that's part of investing. I'm not wishing ill on young people. I'm just saying that the lessons you learn typically in investing are when you're younger. All right, some good, some bad, but the main point is that you learn a lot from that, and you look up, and that's where it makes you a better investor later on in life. But right now, if I was a young person like that, number one, just remember you're on your own. Okay, don't believe all that stuff you hear. You're on your own. So you need to do a lot of work like that, do a lot of reading, do a lot of thinking about that. And then secondly, try to, even if you're younger, try to have a pretty good balance. Okay, have some liquidity and have some have some balance in that portfolio. Don't get concentrated, even though you made a lot of money on it, and just don't get concentrated in one or two areas, because eventually even concentrated areas, it gets tough to make money in them again, and then they go down. And so you want to try to have some balance, even if you're a young person.
Balance is key, as in all things in life. Thank you very much, Ted. Where can we follow you and learn more from you in the meantime?
Well, the best place, David, is Oxbow Advisors. It's oxbowadvisors.com. And you'll see, really, we're very transparent. You'll see all of our market letters and different books. We've written a lot of books. And when we make video comments every quarter, those are on there as well. And, we're not trying to hide anything. We're real simple in what we do. So that's the place to go look.
Thank you very much, Ted. We'll speak to you again soon, and we'll put the links down below to Oxbow Advisors and also to the YouTube channel. I know you and your CIO Chance occasionally puts out very good educational videos on that channel, so we'll put the link down below. Check that out as well. Thank you very much, Ted. We'll speak again soon. Take care for now.
All right. Thank you.
Thank you for watching. Don't forget to like and subscribe.